Our goal is to break the power of the mob in America and nothing short of it. We mean to end their profits, imprison their members, and cripple their organization. Imprison their members and cripple their organization. Cripple their organization. Imprison their members. Break the power of the mob. Our goal is to break the power of the mob in America and nothing short of it. We mean to end their profits, imprison their members, and cripple their organization.
What's up, folks? Giving some time for some more people to come in and view this. There's going to be some important information here.
Imprison their members and cripple their organization. Cripple their organization. Imprison their members. Our goal, break the power of the mob
In America. Yo, what's going on? What's going on, world? This is Alonzo Hall, aka the Blue Blazer, and I've returned with another ADH Wealth Solution. If anyone is new here, make sure that you hit that like. If you're on my Facebook, hit that like and share button. If you're on my YouTube or my Twitch, like, comment, subscribe, share, hit that notification bell so you get notified every time we go live and drop this valuable information for you. Today, I want to go back and speak on some things about how the Fed or the Federal Reserve rates can affect your insurance premiums. So I have an article here from the American College of Financial Services, which, if you do or don't know, I am a financial services provider. And the American College for Financial Services is something that financial professionals or insurance agents and stockbrokers go to separate themselves from the average guys in the pack. So your average life insurance agent doesn't know jack shit compared to what I know, but that's neither here nor there. Let's go ahead and read this white paper from the American College of Financial Services. Bear with me one moment. I'll go ahead and open that window and let's take a look at it. So here it says an article from December of 2020. So this is a brand new article from the American College of Financial Services. And it says lower rates for longer. What does Fed policy mean for the life insurance industry? The last decade has been a complex one for the insurance industry, and the next decade promises to be just as demanding. The industry is grappling with a wide range of changing market conditions, but none is potentially more complicated than persistently low interest rates. In the wake of the global financial crisis, insurance companies faced a harsh new reality of battered balance sheets, struggling customers, and increased regulation. Technological developments and innovation added to industry pressures as emerging new players drove increased competition. But perhaps the most difficult challenge of all was the collapse in interest rates in 2008. After peaking in the 1980s, following a period of high inflation, U.S. interest rates entered a period of secular decline. See Figure 1. Following the financial crisis of 2007-2008. However, the fall in interest rates accelerated as the U.S. Federal Reserve, the Fed, attempted to blunt the economic fallout caused by the collapse in U.S. mortgage rates. After a limited recovery in 2018 and 19, interest rates plunged again in early 2020. The coronavirus pandemic and measures taken to combat it imposed severe economic costs on the U.S., and the Fed acted to support a recovery by slashing interest rates. And here's the chart we were looking at. In today's post-pandemic landscape, the outlook is clear. Interest rates will remain lower for longer. Indeed, in September 2020, 13 of the 17 policymakers that sit on the Federal Open Markets Committee, FOMC, or serve as presidents of Federal Reserve banks, predicted that rates would remain at or near zero until at least the end of 2023. And would rise only gradually after then. So what does this mean? Everybody who's fucking excited over Tesla attaching to the S&P 500 should know that there's a life insurance policy that's been around that's attached to the S&P 500 for over 120 years. So your stocks that are just now getting onto it, that you're basically saying, what you're saying to the financial professional, and I'm going to break this down to basketball, is that Zion Williamson is better than Michael Jordan. Period. That's what you're saying when you're excited over Tesla, but then diminish an index universal life. So then don't say anything when someone says, well, not even LeBron James, but Zion Williamson is a better basketball player than Michael Jordan. You tell someone to get the fuck out your face because they don't know what the fuck they're talking about, because this new kid on the block hasn't proved himself. Meanwhile, we have people clamoring over Bitcoin, clamoring over Tesla, when in IUL has been there for over 100 years. So this leaves insurance companies grappling with a number of tough questions that may prove fundamental to their long-term sustainability. 1, why do interest rates matter? Given the nature of their business, persistently low interest rates can have an impact on insurance companies through multiple channels. One being that they're going to relay the cost to you, the customer. So even not just life insurance, but like your car insurance, it's going to be more expensive because the rates are low. The Financial Stability Institute, FSI, which is housed within the Bank for International Settlement, hopefully illustrates some of the ways in which low rates may affect almost every aspect of insurance companies' operations and financial health. Income and profit. One of the key drivers of an insurance company's profitability is the returns it generates on invested assets. Traditionally, insurers have been conservative investors, favoring stable and relatively safe fixed income instruments such as government bonds or blue chip corporate bonds. In most states, regulators impose limits on the type of assets insurance companies may invest in, further encouraging caution and restraint. Historically, the investment-grade assets preferred by insurers generated meaningful returns. However, as interest rates have fallen, insurers have seen their aggregate investment returns decline as they have been forced to sell high-yield interest instruments and reinvest the proceeds in low-yield options available today. In this environment, insurers' reinvestment risk and diminishing investment income are becoming a reality. Different insurers have different levels of exposure to reinvestment risks in today's low interest rate environment. The problem is most acute for those with a portfolio of assets maturing in the short to medium term, while those with longer duration asset portfolios are more insulated from the risk. Importantly, however, insurers face a two-directional risk when investing in a low-rate environment. Not only do they face the risk that they are unable to find comparable returns, but also the risk that if interest rates rebound after they have invested in new assets, the value of their newly acquired low-yield bonds will fall, putting them at a competitive disadvantage relative to other players that are able to take advantage of rising rates. The only way to avoid this risk is to reduce the duration of assets held as a hedge, which would amplify assets and liability duration mismatches. In short, the situation is highly complex and may pose a significant risk to insurers' profitability. Policyholders generally have first claim on insurance companies' assets and cash flows, which means that as returns decline, profitability may take an immediate hit. This dynamic could make insurers less attractive to investors. This pattern of interest rate sensitivity can be seen in the relative performance of the S&P 500 and the S&P Insurance Select Industry Index over the last decade or so. So again, if any fucking KNEEGROW says any BS to me about I'm good on life insurance, but I'm excited about Tesla, I will refer to you this, where Tesla is going to join the S&P 500, but there's also the S&P Insurance Select Industry Index that's been performing for more than a decade. Tesla is a new stock. When interest rates began to rise in 2016-17, the insurance sub-index outperformed the broader S&P 500 index. So the insurance index that stands behind the S&P 500, where all you guys are investing in the stock market and are going crazy, got outperformed by the insurance stock market. So the insurance market did better than the traditional S&P 500. Right? It says when the interest rates began to rise in 2016-17, the insurance sub-index outperformed the broader S&P 500 index. But as rates plunged in 2020, the insurance index lagged to the broader market. By October 2020, the S&P Insurance Select Industry Index offered an annualized 10-year return of 8.86%. While the S&P 500 did offer an 11.38% return, indicating significant insurance industry underperformance. Basically, because too many of you dumb niggas ain't buying insurance, which is a guaranteed thing. You buying these stocks, which is guaranteed to it's not guaranteed to do anything. You may make money. You're likely going to lose money, but it sounds nice. Right? You see this word here, risk and solvency. A lot of people don't have a risk tolerance to even be investing in Tesla. You put your money in Tesla. If you invested your money with me right now, $10,000, and then tomorrow I turned around and said, Mr. Customer, we invested in this and your $10,000 went from 10,000 to zero, you'd be ready to choke me, which means you don't have the risk tolerance to invest, which means you should not be investing. You only invest with what you have the risk tolerance to lose. Just like you wouldn't lend your cousin Rodney, who smokes too much, some money, unless you knew you didn't need it. Low interest rates may also change insurers' risk profiles in various ways. As noted, insurers have traditionally been highly conservative investors. However, as yields on risk-free instruments have fallen to near or even below zero, insurers may feel pressured to look for greater spread to generate their returns that they need. The so-called search for yield has driven insurers to invest in instruments such as lower-rated corporate bonds. As more insurers move as far up the risk spectrum as possible within regulatory limits, Systemic risk in the insurance industry increases, as does credit risk at individual firms. So again, if you're talking about your credit, just so you know, your credit is affected by your insurance, and your insurance is affected by your credit rating. If you don't know, when you're looking at the financial, like the S&P, Standard & Poor's, even though it's an indice, S&P, Moody's, and there's another one, are financial rating companies, AM Best, S&P, and Moody's. Those are there to rate, for example, the credit of the country. While Barack Obama was president, AM Best and Moody's brought down America's credit rating. So America has bad credit. The country has bad credit. Research from Fitch Ratings indicates that the credit profile of insurers' asset books has deteriorated in recent years. Traditionally, insurers held mostly A-rated bonds before the financial crisis. Such instruments comprised almost 70% of insurers' portfolios. However, by the end of 2018, that proportion had fallen to around 61%, while the share of BBB-rated bonds rose to 34% from 25% before the crisis. BBB, Better Business Bureau, rated bonds are just one notch above junk. So junk bonds, or a triple B, which is actually a credit rating. A-rated would be good. Double A, triple A better. B-rated, and then the lower. Triple B-rated bonds are junk bonds, meaning people with money probably aren't going to invest in those. Those are going to be people who are trying to get into investing. And then the stockbroker is just going to give you the crappiest thing possible and charge you the highest commission. So the shifting composition of insurers' corporate bond portfolios indicates an uptick in portfolio credit risk. Higher credit risk means that insurers are exposed to a greater risk of losses in the event of an economic downturn. As insurers become exposed to greater credit risk, their own credit risk profiles may also deteriorate, potentially increasing their financing cost and further harming profitability. However, it is important to note that some see insurers increasing investment diversification more positively. They note that, in addition to taking on greater risk in corporate debt markets, some insurance companies are also increasing their exposure to municipal bonds and other highly rated instruments, thereby increasing their portfolio diversification and mitigating against increased credit risk to some extent. Beyond greater credit risk, insurers may also face rising insolvency risks in a low interest rate environment. When assessing their solvency and capital adequacy, insurers evaluate the present value, or PV, of their liabilities and assets. Falling interest rates, which are sometimes used as discounting rates to determine PV, will generally increase the PV of assets and liabilities. However, to the extent there is a duration mismatch, the value of liabilities may increase more than the value of assets. This may have implications for their long-term solvency. Importantly, not all insurance firms use long-term interest rates to discount their asset and liability positions for purposes of determining their long-term solvency. As noted, U.S. state regulators take a risk-based capital approach to assessing insurance firms' financial health, and many regulators and insurance companies believe that it is inappropriate to use long-term interest rates to assess positions with multi-year or multi-decade durations, given rates' inherent volatility. What that means is basically the market is so up and down that the insurers really shouldn't be worried about muni bonds or any of their the rates, because they do this shit. See, your regular investor is worried about it day to day. Your true investor, or your institutional investor, which would be companies like this, are worried about it decade to decade. There's a difference. You're worried about day to day. They're worried about decade to decade. They put the money in there and let it sit for 10 years. And oh my God, it went up. Oh my God, it went down. Nope. Whatever happens, across that duration of the 10 years. We'll visit it at the end of that 10 years. That's an investment strategy. Otherwise, you guys are just gambling. Nevertheless, insurance firms do face meaningful interest rate risk, and this may ultimately affect their long-term solvency if interest rates remain at or near zero and they take no action to address the issue. An important corollary of the above dynamic is that falling interest rates also change the calculus for policyholders. So this is why it gets important to you. Those who hold policies with attractive guarantees written before the plunge in interest rates will see the current value of those policies rise as rates fall. Oh, so you mean if I got my policy a little while ago and looked at it as an investment instead of a death benefit check, I could be making money right now off of the insurance company? You mean to tell me that, like the video I did last where I showed you if you keep a life insurance policy for at least 10 years, the life insurance policy starts paying you for having it? Oh, but no, motherfuckers don't want to watch this. I probably have nobody watching this video. Well, I have one person watching this video. But this shit isn't interesting. And we didn't find out that the Federal Reserve actually, or that your life insurance company actually invests. What's going on, She? What's going on, brother? We got some YouTube family here. What's going on? So as I continue, an important corollary of the above dynamic is that falling interest rates also change the calculus for policyholders. So those who hold policies with attractive guarantees written before the plunge in interest rates will see the current value of those policies rise. So the policy that you had, as long as it's a cash value policy, prior to the interest rates plummeting, and now all your financial stuff is going up. See, when the Fed rates go down, that's good for investors. When the Fed rates go up, that's bad for investors. Okay. This may make them less likely to surrender those policies before maturity, right? Because now you're seeing, hey, that cash value that I'm getting, instead of, 2% a month, I'm getting 4%. So instead of $2 a month, I'm getting $4 a month. Meanwhile, with my Wells Fargo, Bank of America, or Chase Bank account, I'm getting 75 cents a year off of a $100 balance. Meanwhile, that same $100 is getting me $2 a month on my life insurance. Oh, wait, the Fed rates are going down. That $2 is now $4 a month. Gee, Williker, I wish I didn't get this life insurance policy so soon. I wish I waited and shitted on the guy selling me life insurance because I thought it was just a death benefit check. Didn't even spend the time to talk about it with him. Oh, gee, Williker. There's a bunch of stuff you can do. So, let's see. These behaviors may be contrary to the assumption that insurers use to calculate their liabilities, and therefore may pose an additional source of solvency risks. So, the business model. The dynamics around income, profitability, and risk have broad implication for insurers' business models. As interest rates have fallen, insurers have been forced to reprice their policies to reflect current market conditions. What this means is, for example, 2 years ago, I had a 20-something-year-old black man ask me, well, why would I get life insurance now instead of wait until I'm about 40 or wait until I'm about 5 years away from dying? And I said, let's go play lotto right now, because if 5 years before you die, and you know what the numbers are. He said to me, oh, man, quit playing. Well, bro, 5 years before you're going to die, so you obviously know what the numbers are. See, we have to start thinking about this right and exact. Now I'm talking to Black America, because we've been taught something completely different. You would be surprised how many people I talk to, and I say, listen, the wealthy insure one life 7 times. Oh, my God, can you tell me what those policies are? Well, first, there's just one policy for your burial. Then there would be, if you get married, you're going to get a policy for your spouse. Then if you buy a house, you're going to get a policy to protect your mortgage. Then if you open a business, you're going to get a policy for your business. Then if you have kids, you're going to get a policy to leave them money. That's 5 policies right there. And we haven't even talked about really anything outside of shit that normal people do. I haven't even said anything that's a wealthy people doing, except for maybe starting a business. But all these 5 policies that I just spoke of are fucking shit that we do regularly. Right? So, what are we doing here? What's good, Perfect Imperfections? I want to say a shout out to you and thank you for my first interview. And that's the gentleman who did the first interview with me, which I played here recently, which was my why. So make sure you go like, comment, subscribe, share here. Make sure that you follow him. Make sure with me you support the Cash App so that I can grow and bring you more content like this. So it says the business model. The dynamics around income, profitability, and risk have broad implications for insurers' business models as interest rates have fallen. Insurers have been forced to reprice their policies to reflect current market conditions. In general, this has meant higher premiums in the case of certain types of policies or lower guarantees. This repricing and restructuring of products, which the insurance companies change that every 3 months, just so you know. This repricing and restructuring of products have made certain types of insurance contracts relatively less attractive compared to other financial products. This impacts insurance firms' revenues, which in turn lowers long-term profitability and increases solvency risks. It is important to note that not all insurance products are equally affected by the dynamics outlined above. Short-term property and casualty, or P&C insurance products like your car insurance, such as auto insurance policies, are significantly less exposed to interest rate risks as they are generally renegotiated every 6 or 12 months and are frequently repriced to respond to changing market conditions. The products that are most exposed to the risks described above are long-term contracts, especially those with investment or return guarantees, such as annuities or certain types of life insurance policies, such as whole life, with promises a guaranteed payout. Wait. So life insurance has investment aspects to it? I thought it was just a life insurance policy. Oh, no, it's actually a little bit more. Okay. So again, I'm not faulting folks for not knowing, because you don't know what you don't know until you know you don't know it. And companies like these insurers, their job is to not teach you this stuff. Their job is really to get a person like me to come in and say, hey, you need 50,000 and this much, sign here, see you later, and leave you exposed. What is the outlook for interest rates? Given the many ways in which low rates may negatively impact insurance companies, it is important to understand the interest rate outlook in order to assess the risks facing the industry and individual firms. As noted earlier, U.S. nominal interest rates are presently at historically low levels. Low nominal short-term rates are, broadly speaking, a consequence of Fed action. In response to the economic pain caused by COVID-19 and the subsequent shutdown, the Fed slashed interest rates and announced a significant program of quantitative easing, flooding markets with liquidity and driving down short-term rates. At the same time, the federal government rolled out various fiscal programs such as enhanced unemployment benefits and a program of forgivable small business loans, issuing billions of dollars in federal debt to fund them. These efforts helped ease the worst of the crisis, and the U.S. economy has since shown signs of recovery. However, the waves of COVID-19 may not yet be over. Additionally, unemployment remains elevated. Labor force participation has slumped. Inflation remains subdued. The recovery in consumer spending appears to be slow. And most economists anticipate a prolonged period of below potential growth. Bear with me one moment. I need to wet my lips here. All right. As Fed Chair Jerome Powell put it in his September 2020 speech, economic activity has picked up from its depressed second quarter level, when much of the economy was shut down to stem the spread of the virus. With the reopening of many businesses and factories and fewer people withdrawing from social interaction, household spending looks to have recovered, about 3/4 of its earlier decline. Nonetheless, spending on services that typically require people to gather closely, including travel and hospitality, is still quite weak. The recovery in household spending also likely owes to federal stimulus payments and expanded unemployment benefits, which provided substantial and timely support to household incomes. Against this backdrop, the Fed intends to keep rates at their present low level until there is a sustained improvement in the unemployment rate and inflation recovers. As noticed, as noted, many Fed policymakers anticipate that rates will remain low until at least 2023. This response has had a number of financial market impacts. The combination of Fed action and subdued inflation has pushed real interest rates, the return that bond investors can expect to receive after accounting for inflation, into the negative territory. The yield on 10-year T-bonds or Treasury inflation securities TIPS hit historic lows in 2020, indicating that investors anticipate a low and slow economic recovery and increased inflationary pressures. While Fed action and the subdued economic outlook are significant drivers of the low interest rate environment, it is important to understand that there are also deeper structural factors at play. As noted earlier, nominal U.S. interest rates have been falling for many decades, long preceding the global financial crisis. Research indicates that the fall in real interest rates has followed a similar pattern. Real rates have trended downward since the early 1990s. Some observers believe that the long-term fall in interest rates is being driven not only by central bank actions, but also, and perhaps more importantly, by demographics. The U.S., like the rest of the developed world, is facing two long-term demographic changes. First, people are living longer. So this is why things like people in our 40s need to worry about privatization of Social Security and retirement, because people are living longer. So Social Security is likely something that people 45 and under will not receive. Especially when you have millennials who are not paying into the system the same because they are creating their own businesses and not working jobs. So there's a balloon effect. Some observers believe that the long-term fall in interest rates is being driven not only by central bank actions, but perhaps more importantly by demographics. The U.S., like the rest of the developed world, is facing two long-term demographic changes. First, people are living longer. Life expectancy at birth for Americans has risen steadily, while the average retirement age has remained more or less constant, meaning that Americans are spending much longer in retirement than they did historically. Secondly, the U.S. population growth rate has slowed significantly. The slowing population growth rate is the result of many factors, most importantly, the U.S. fertility rate. The number of children born to the average woman has declined steadily since the 1960s. However, other factors such as the fall in net inward migration, a traditional source of U.S. population growth, has also played a part in slowing growth. This combination of increased life expectancy and falling births has led to significant population aging. A growing proportion of the U.S. population is older, and a falling proportion is younger. Population aging can have an impact on the so-called natural rates of interest through various channels. When people expect to spend longer in retirement, they need to save more during their working years. This means that while they are working, they will tend to consume less and save more. This may lead to lower economic growth because consumption demand will be lower. At the same time as the population ages and fewer new babies are born, the working age population shrinks. Fewer workers means lower potential output unless there's significant productivity growth, which has not been the case in the United States in the recent decades. Other channels of impact may include a reduction in economic innovation and dynamism. or dynamism. As the result, population ages and changing investment risk tolerances as older individuals favor less risky investment instruments. Thus, it is possible that the subdued interest rate environment of recent decades is not simply a monetary phenomenon, but rather a structural reality that will persist for many years to come. Insurance companies, therefore, must prepare for a possible future in which interest rates do not rise to historical levels for many decades, if ever. So, how insurance companies can thrive in a low rate world? Insurance companies are adaptable businesses and experts in managing risks. Many have shown remarkable resilience and innovativeness in the face of low interest rates, both in the United States and worldwide. The Japanese experience. Japan is an instructive example of how insurance companies are able to adapt to low interest rates. Japan entered a period of secular low interest rates over 2 decades ago, following an economic downturn in the late 1980s and early 1990s. The Bank of Japan, BOJ, Japan Central Bank, lowered interest rates in a bid to boost growth. While Japan has since experienced periods of positive but slow growth, it has never returned to the full-blooded growth it experienced in the 1980s, and interest rates have remained low since the early 1990s. Japanese insurance firms have therefore grappled with the reality of persistently low interest rates for decades and have found ways to adapt and survive. Their experience offers helpful lessons to firms in the U.S. facing a low interest rate environment. Japanese insurers' strategies for adapting to the low rate environment generally fall into 3 categories. Product mix adjustment. So Japanese insurers have generally shifted their business lines away from life insurance products, offering generous long-term guarantees and other savings or investment products in favor of pure insurance plays. Meaning, oh, yeah, y'all gonna be some cheap motherfuckers and try to buy the cheapest product? Gotcha. We'll just sell you this term stuff, and then when the term is over, we'll jack up the price, but, you'll feel good because you saved a few dollars. But, you didn't get the high interest savings or the benefit of when the insurance company is fucked up, you're still making money. But, life insurance is just a death benefit check. So, protection-oriented products that generate earnings based on underwriting profitability rather than investment returns. Similar shifts are already well underway in Europe, and the U.S. whole life products with their guaranteed returns have fallen out of favor, and there has been a switch to term life products. Ooh, that sounds like Sue Zorman and Dave Ramsey. Buy term, invest the rest. Just buy a term policy. Just buy a term policy. One of Dave Ramsey's largest holdings is a cash value life insurance policy. Yeah, they're telling you to buy term and invest the rest so that you go with them and pay 2% of your net worth because you bought a mutual fund, and then pay 20% of your gains. So if you get 10% gains, you're going to pay me 20% of that. So did you really get 10% gains, or did you get like 4%? Because you paid me 20% of the 10%. Plus 2% of your net worth every year, regardless of if you buy something or not. Meanwhile, your life insurance agent can do all the same shit for free $99. But, you feel good feeling like, hey, I went to a stockbroker. Sounds nice. It's just like if you go to the barber or the hairstylist, right, as men. If you go to a hairstylist as a man, you're going to pay more for the same haircut that you would get from your barber. So at any rate, however, insurance companies can do more with the population aging. The need for tailored retirement products is greater than ever, and insurance companies have a role to play in developing instruments. Give me 1 second there. This is Alonzo speaking. How can I help you? Sorry, ladies and gentlemen, I had to answer that. Money calls, and when money calls, you have to answer, especially for the people that I have interest in. If you'll bear with me for 1 second, I want to send something off to someone. Bear with me. Copy here. And let me just send this to this gentleman, and then we will continue. Also, I hopefully will be bringing a buddy of mine up who can help us find funding, because often there are businesses that us as Black people want to open, and unfortunately, sometimes we don't have access to those funds. However, insurance companies can do more with the population aging. The need for tailored retirement products is greater than ever, and insurance companies do have a role to play in developing instruments to help consumers to prepare for their retirement and generate the retirement income they need. So, revised investment strategies. Japanese insurers shifted their investment strategies to adjust to the low to negative rates available on government debt instruments. This included revising the asset mix to include a broader range of assets and moving into foreign currency denominated products and assets to take advantage of the favorable yields available offshore. This reminds me of, there's a gentleman who I speak with who sent me a beautiful article on Swiss insurance and annuities. So, those Swiss bank accounts actually do exist. As noted, U.S. insurers are already shifting their investment mix into a bid to generate higher returns, including accepting higher levels of credit risk and diversifying into new types of assets. Insurers may find ways to further diversify into real assets, such as commercial real estate, and instruments such as collateralized loan obligations, or other asset-backed securities within regulatory limits. So again, insurance companies can invest in certain things, but as they are institutional investors and they have billions of dollars to play with, billions of your dollars, by the way, then they are regulated onto what different things they can invest in. And then I do want to take a quick second to talk about insurance companies, because there are some insurance companies that are publicly traded, and there are some insurance companies that are owned by their policy holders. So anytime you hear whatever mutual, a mutual company is owned by its policy holders. So when you purchase a policy from, let's say you buy your car insurance from State Farm. State Farm is a mutual company. So now that you have your car insurance with State Farm, you own State Farm partially. Now, on the flip side of that, let's say you get your car insurance from Allstate. Allstate is a publicly traded company with shareholders to appease. So when you put your money with Allstate and you buy a policy, all you are is a policyholder. You're not an owner of the insurance company, because it's not a mutual company. Whereas a mutual fund will be a mutual company. So, global diversification. Many Japanese insurance companies choose to diversify offshore to take advantage of growing markets outside of Japan. Moving into new markets can be a way for insurance firms to tap into new demographically dynamic populations and new asset pools. However, there are significant risks associated with moving offshore, including increased regulatory complexity, high startup costs, and exposure to new geopolitical risks. Other ways to adapt. In addition to adjusting policy, product lines and investment strategies and diversifying into new markets, there are many other levers companies can pull to adapt to the low interest rate environment. Operational improvement. Insurers can enhance their profitability by focusing on costs. By taking advantage of new technologies, for example, insurance companies may be able to lower their operational budgets. Software can help trim costs in business areas as diverse as risk management, compliance, customer service, and the back office. Insurers may also choose to pool operations with other insurance companies to lower costs and generate improved economies of scale, or to pursue more aggressive outsourcing of functions traditionally performed in-house. In addition, firms can reorganize their distribution operations to align more closely with product line profitability, thereby ensuring that their sales operations are targeted at promoting the most profitable products to the right consumers. Tackling non-traditional markets. With their extensive expertise in risk management, insurers are well positioned to develop products to help consumers manage novel risks, such as the risk of divorce or unemployment. By doing so, they can increase their relevance to consumers, many of whom have been deterred from seeking out insurance products due to their perceived complexity and seeming lack of utility. Many individuals today worry less about untimely mortality and more about outliving their retirement savings or facing unanticipated financial headwinds during their working lives, which is why you need to sit with a licensed insurance agent. Repricing and renegotiating products. In cases where products are highly exposed to interest rate risks, such as annuities or whole life insurance policies, it may be necessary for the insurer to renegotiate the contract with the policyholder. Typically, renegotiation is a last resort, one that U.S. insurers have not turned to yet. Where it is necessary, however, renegotiation can see the insurer raising premiums or reducing or altering guarantees in order to ensure its long-term ability to meet the terms of the policy. So what does that mean? Prime example. I showed you guys a video where I did an indexed universal life with a woman in 2013. And at that point, her compound interest rate was 6.7%. If I do that same policy for that same woman today, she's lost 0.3% interest because the interest rate as of today is 6.4%. Now, obviously, you want that 0.3% because every penny counts. So time is of the essence, folks. Hedging and other financial products. Where possible, firms can use reinsurance derivatives and swaps to hedge their risk on products exposed to higher levels of interest rate risks. While the use of hedging instruments in reinsurance contracts exposes a firm to greater levels of counterparty credit risk, such tools can nevertheless help to offset some of the financial risks associated with low interest rates. Developing greater customer insight. Dramatic improvements in artificial intelligence and the emergence of the Internet of Things, whereby many common devices can be linked to the internet and used to gather data for analysis, means that insurers today have the ability to understand their consumers better than ever. In the case of life insurance, for example, data-driven programs have the potential to enhance underwriting profitability and lower premiums for consumers. For example, the Vitality line of products, pioneered by the Discovery Group, a South African insurance firm, uses a wide range of monitoring tools to track policyholders' health behaviors and promote healthy lifestyles, including wearable exercise monitors and apps, and other instruments. Healthy policyholders receive favorable premium rates, and Vitality has seen a 35% reduction in mortality among highly engaged members. Ultimately, insurers may be able to engage in what McKinsey calls continuous underwriting, making micro adjustments to the policy pricing based on data drawn from monitoring policyholders' behavior over time. Reimagining the insurance business for the low-rate world. As we've seen, low interest rates pose a significant obstacle that insurance companies must address head-on. The outlook for the economy suggests that rates will remain low for the foreseeable future. Indeed, even if monetary policy tightens over the next few years, structural demographic factors may mean that real interest rates remain subdued for decades to come. Therefore, insurance firms must learn to adapt to a low interest rate world. There are many operational, strategic, and financial levers that companies can pull to mitigate or avoid the impact of low interest rates. By leveraging financial products, new technologies, and their traditional risk management skills, insurance firms can redesign their product offerings to be more attractive to consumers and more profitable. Smart insurance companies can adapt and innovate to thrive in this new world. This is just-in-time knowledge for a just-in-time world, straight from the American College of Financial Services. So, ladies and gentlemen, that was the brief video for today. As always, make sure that you like, comment, subscribe, share, hit that notification bell. Support the channel, hit the Cash App. Make sure you visit my Instagram and my Facebook. And as always, with that being said, peace and Black power. One love. I am gone.
Our goal is to break the power of the mob in America and nothing short of it. We mean to end their profits, imprison their members, and
Cripple their organization.
imprison their members and cripple their organization.